and I'm actually surprised it's actually in this guide for the partnership because of what I'm about to explain here. If they don't meet, if the nonprofit no longer participates in the property, or as an example, loses its nonprofit status, and I've seen this before, and they're the only nonprofit in the partnership, and on their 8609, the box is checked off that they receive a nonprofit allocation, then they're not following, they're no longer under 42C, that they meet this nonprofit set aside, and from our standpoint, from that point forward, they lose credits, or they potentially could lose credits. And then that's an important point to bring up here. If there's no recapture, because it's not a recapture event under 42J, but they do lose the tax credits, and if the taxpayer happens as potentially falls out of this non-compliance on 42C, we can look back to, and they describe this in the audit guide, that there's a CCA out there pertaining to casualty loss, and that may be our fallback as to if the nonprofit were to receive its nonprofit status back, then and do that within a reasonable time, then we do not run in. Then we are able to claim the credits back when they come back into compliance. Excuse me here. And in this point, with the non-compliance piece, it's determined just like with the casualty loss item, we look at the last day of the year whether or not the nonprofit was a qualified nonprofit.